My name is Jim Lee. I'm the founder of Strategic Foresight Investments, a boutique investment advisory firm here in Wilmington, Delaware. Over the years, I've learned a few things about investing. The first of which is if you want to be in the right place at the right time, sometimes it's useful to show up a little early. I've also found that some things are a lot easier to predict than others. It's hard to predict the direction of the stock market, but it's actually fairly simple to anticipate the flows of funds coming and going to and from the market. And it's fairly easy to sort of intuit how this works. There are some seasonal and calendrical factors that seem to work on a year in, year out basis. The first of which, imagine it's the beginning of the month, you just got paid, money's going to go into your 401k plan, and that in turn might go into index funds. Similarly, in April, if you get a tax refund or if you're done saving up for taxes, some of that money might go into the market. In December, if you get a bonus, chances are you might want to spend some of that, but some of that might also go into index funds by the end of the year as well. There are also periods of time in which money stays out of the market, the most notable being summertime, if you're going on vacation and you just don't want to worry about your investments. So what I do at the end of each year is I build a trading calendar for the next year based on historical probabilities of making money during each day of the year, adjusting for things such as weekends and holidays and options expiration dates. And this changes a little bit from year to year, so the dates do move around a little bit, but generally speaking, you'll see that I'm invested in the beginning of each month. I'm also invested typically in the middle of each month. There's a very strong 2-week cycle in the S&P 500, and sometimes invested in the end of the month as well, particularly around the holiday season. This forms what I refer to as my decaffeinated market timing strategy. And it's for people who get the jitters, they don't like a lot of excitement, they might not want to be in the market all the time. So I use a combination of the RIDEX S&P 500 Index Fund, which is a no transaction fee fund, and cash, typically in cash more than half the time. So the goal here is to generate mid-single digit annual returns with less volatility than buy and hold of the S&P 500 index. And these are third-party audited results, audited by Theta Research, using live money, net of fees, since inception of the strategy in November of 2015 through the end of January. You can see that by and large, this decaffeinated strategy in dark blue has been just super stable relative to the market, capturing some fairly nice upside as well. If we break this down on a year-by-year basis, you can see that for the first month of 2020, the strategy was down a bit. I can tell you that with the last 2 weeks on the pandemic, it's now leading the market by a few percentage points. Most interesting thing here was really 2018, when the market was down 4.3%. The strategy was up close to 12%. So the results have been fairly consistent, non-lumpy, averaging about 10% per year from inception. Capturing roughly 3/4 of the gains for the S&P 500 while being invested roughly 40% of the time. So that looks pretty good. But you can say, hey Jim, this just goes to prove you can't prove the market, you can't beat the market by trying to time the market. And there is actually a way to do that, and that is to use a little bit of caffeine. So I have something also called the caffeinated market timing strategy, and this is for people who want a little bit more excitement. Uses exactly the same trading signals as decaf, but this time coming and going from the direction monthly S&P 500 Bull 2X fund, meaning that it's going to move twice as much as the market, up or down, every day that it's invested. And the goal here is to outperform the S&P 500 over time. It's a strategy that's suitable for aggressive investors, and it works the best in non-taxable retirement accounts. So this is the growth of $1,000 going from inception, again, November of 2015. Net of fees, pretty stunning, particularly the last few years here. Break that down. Again, a little bit of a lag in January. Relative performance has gotten pretty strong actually over the last few weeks. Last year, 2019, strategies up 25%, up 26% in 2018 when the market went negative. In 2017, it lagged, and then 2016, the last election year, it lagged about 7 percentage points. But overall, fairly steady returns, non-lumpy. I like to see that. Over the last year, 32% versus 21%. 3 years, almost doubling the annualized returns of the S&P 500 Total Return Index, and from inception beating the market by almost 10 percentage points per year. This is more volatile than the market, though, measured by standard deviation, about 15 percentage points of standard deviation per year. Sharpe ratio is still pretty good here. Worth mentioning also drawdowns. This is going to have some downside if it's invested in the market. In December 2018, it was down 25% in just 2 weeks. So there is that to consider. It's only suitable for the risk tolerant. What I find most interesting, though, is that the strategy has a relatively low correlation coefficient, meaning that the market doesn't necessarily have to go up on a month-to-month basis for this strategy to work. According to Zacks research, monthly upside capture of 1, monthly downside capture, meaning that when the market is down for the month, this typically loses a quarter as much as the market. So we have a high alpha, low beta strategy. Looks like a great diversifier for client portfolios. Really pretty happy with how this is turning out. Now, the practicalities of using these strategies, again, they work best for non-taxable accounts. They generate lots of short-term capital gains. They also generate some wash sales. Although it is worth mentioning that I'm beginning to use the decaffeinated timing strategy as an alternative to bond funds, which are only yielding, in the zone of like 3 to 4% right now. Strategies are suitable for small accounts because we're in and out of just one fund. We're not holding a lot of different positions here. On the other hand, there are no assets under management limitations on the upside because we're trading the most liquid index in the world, being the S&P 500. So size is not an issue either on the high side or on the low side. I feel that all advisors should have somewhere between 10 and 20% of their client portfolios in some type of tactical strategy, such as caffeinated and decaffeinated. So a little bit about StratFI. Founded in 2012, ringleader of a one-man circus with 2 staff members at this point, helping me out with trades and paperwork. Currently managing $40 million of assets under management, about $4 million of which is in these caffeinated and decaffeinated market timing strategies. So thanks again for your time and attention. Here are some disclosures for you. And if you have any questions, feel free to reach out, and I'd be happy to talk to you and chat a little bit more. Thanks again. Bye-bye.